Welcome back, everybody, to the Today's Market Explained, a podcast and video series by Four-Star Wealth Advisors. I'm Brian Kasal. I'm your host. I'm here with Chris Reardon, my co-host. Chris, welcome to the podcast.
Thanks, Brian. Glad to be here and talk a little bit about the markets and give everyone an update.
All right, everybody. So Chris is our four-star director of development. He's the master of all things portfolio and trading. He's a Cleveland boy, loves those Indians. And he's got three young children under what, 2.5, right?
2.5. The oldest is 2.5. So yeah, I guess under 3 if you wanted to round up.
But he's at the young spectrum of this, and he's got a young man's perspective. So welcome, Chris, to our show today. And I'm Brian Kasal. I'm your host, founder and CEO of CIO, also of Four-Star Wealth. I'm an Eagle Scout, trustee of the Boy Scout Foundation, National Boy Scout Foundation. I'm advisor to CEOs and insiders, and I'm husband to the amazing Tripty and chief dad to Evan and Quinn. So that's my story, and thanks for being with us. If you like what you're hearing, we ask that you tell your friends about what our show is doing and the things that we pass on. And also give us a 5 out of 5 ranking. That would be very helpful as we try to get rankings throughout the podcast world. We have been ranked in the top 1% of podcasts in the country, so we're proud of that. And we just found that out actually about 2 weeks ago by our podcast engineer. So we're one of the most listened to podcasts in the world. I think there's 3.8 million podcasts in America, and we're in the top 1%. So there we are. So thank you for all of you who are listening. Chris, today we'll do our market commentary, and then we'll talk a little bit about the economy and then other interesting things that we see out there. Chris, do you want to go through what changes we've had since our last show?
Mm-hmm. Yep. And so from the asset allocation perspective, our last show, it was pretty much, we can kind of benchmark it at the end of January. I think it was like January 30th. So kind of for the first half of February, we still have domestic equities leading. It actually gained 5 points in the first half to 309. So we continue to see domestic equities gaining and getting ground in that top position. International equities held steady in the number 2 position at 252 tally points. So no change since the last podcast. In the number 3 position, we have commodities. It's at 196 and -3 tally points from the last podcast. So we continue to see commodities weaken. Oil's picked up a little bit. We have seen oil start to tick up a little bit, but outside of that now, precious metals is seeing a little bit of pressure. So we're really having a lot of different variables that are really impacting the broad commodities market. Cash is in the number 4th position at 147, equal on the week. Currencies is in 5th at 98, and it was -1 on the week. And fixed income is still in last, 85 tally points, equal. So not a whole lot of change. I would say the biggest news, if you will, or the biggest thing of note would be domestic equities continuing that upward trend. It did breach into that 300 tally point mark, which is good to see. And then commodities continuing to weaken. Even though we're getting a little bit of life out of the oil markets now, a little bit, it continues to overall weaken.
Right. And so this is typical of markets where a trend finally sets in, and then all of a sudden we see volatility goes down, and then all of a sudden things start kind of slowly rising. The U.S. stock market gained a little bit, but not much. But a bunch of the other groups, international, cash, and fixed income, were unchanged, which is unusual. In considering all the things that have gone on in the last 2 years. But that may be a sign that we're getting ready for a sustained uptrend.
Mm-hmm. Yeah, I mean, when we do see, especially domestic equities reach into that 300, 320 plus tally points, is usually when we see kind of a sustained uptrend, at least for the next, couple months or the next year. Obviously these things can change very quickly. It's a very much a news-driven market. So as more, inflation news comes out, things like that, these numbers could change rapidly. But from what we're seeing now and everything, it looks like it's a sustainable growth market from what we're seeing and what the numbers are telling us.
And we broke a new record, didn't we, Chris?
Yep. So just last week, the S&P 500 closed at a record of over 5,000 points, and that was fueled by mostly positive earnings reports that we've gotten so far. They beat estimates. I believe it was Thursday last week. The S&P 500 crossed above that 5,000 mark, and then on Friday it did finally close above. So, the stock market continues to be really firing on all cylinders. Seems like all the earnings coming out continue to be mostly positive, which has helped propel a lot of stocks, upwards. So for the most part, what we've seen, I think, has defied a lot of expectation from what people are kind of looking at. But the biggest, I'd say, uncertainty over the market right now is the Federal Reserve and whether they're going to lower rates, raise rates, which is still a possibility out there, or hold steady, and when will those changes happen?
Exactly. Well, and so some folks are saying, well, the market's way ahead of itself because we're seeing layoffs, we're seeing some slowdown in certain areas of the economy. But if you look at the S&P 500, and this is an issue that we've been dealing with all for the last 2 years, these large AI stocks have been dominating the market. So 40% of the returns of the market last year were all from those AI stocks. So now, if you look at the S&P as calculated, it's about 20, not quite 20 times earnings. But yet, if you take out those top seven names, the rest of the market's only at about 16 and a half times, which is below fair value and certainly not overvalued. So, maybe the market has a lot more room to go here. And, these large tech names have dominated the market and they continue to dominate the market. Now we're having a down day today, but that was because of inflation numbers that came out. Um, so we'll get to that in a second. Chris, the week ended 2/9, February 9th, was an up week. And it was the first time since 1972 that for the last 15 weeks, 14 of the 15 weeks have been up. So last time since 1972, we had a 14 out of 15 week stretch of up markets, right? So, that was a decent economy in the early 70s. Of course, it got really bad later, about a year later, actually, in 1973, when the OPEC was formed and the oil embargo was formed. And so oil prices went from $3 a barrel in West Texas Intermediate crude to about $18 a barrel. That's six times. That's like going from about $70 a barrel now to almost $500 a barrel overnight. What would that do to our economy today if we one day woke up and within a week oil was at $500 a barrel? It would be catastrophic because of the amount of fuel that's used in our economy. That's what happened in the 1970s. Same impact. So it's interesting. So that happened right after the 1972. Now, I'm not predicting that because the same occurrence happened that the next thing is going to happen. We're in a very different economy right now. We've had a pandemic. We're coming back from a slight recession in 22 and things like that. So it's an interesting, but that was the last time that happened. It was 14 out of 15 weeks, Chris, is in 1972. But earnings growth is up 9% so far for the companies that have reported, which is solid. So we could have good earnings growth. And the other thing that tells us possibly the markets could go higher is there's $6 trillion in cash sitting on the sidelines. Now, cash is in money funds, money markets, and money markets are paying 5%. So that's a pretty good yield now. A year and a half ago, we were getting 1% or less in a money market. So that's pretty good. So maybe that money will stay there for a while, but I think a lot of it eventually will come out, and some of that money could help fuel the stock market. So we'll see if we don't see a big rise in inflation and see layoffs ensue and other things, that we could have a really good economy, could have a really good stock market. Chris, let's talk a little bit about the economy.
Yeah. So, and I think that's a great point, what you had mentioned in the 70s, Brian, because it does point to the fact that even though things, as we can see now, seem strong, I mean, there's things out there that we can't foresee. Obviously, there's a lot of geopolitical risk going on right now in the Middle East, even in Asia, the Asia Pacific. So there's a lot going on around the world that could throw a wrench even in the U.S. There's even if it doesn't happen in the U.S. So I think it's an important thing to note. So economic front, the U.S. CPI, Consumer Price Index read came out today. It increased 0.3% in January after gaining 0.2% in December. So we did see a little bit of a hot read there, I think, and most of that had to do with some of the core price increases, which I think you had pulled up, Brian, the
Yep.
core price increases. So it was at 3.7% increase on the core price, which that excludes food and energy. So it's usually seen as kind of the more, um, as far as more volatile. If that's really spiking up, then it shows that the inflation is more broader, I guess is where I was looking for, more broader
Well,
than anticipated. So,
Chris, correction, the core inflation was up 3.9 and the expectation
3.9.
3.7, right? And so it was above expectations, and that's why the market's down today.
Yep. And even the CPI, the flat CPI read was above expectations because the expectation was 0.2%, I believe, and it was a 0.3% read there too. So market's down today, and a lot of this is interesting because a lot of it's based off of when the Federal Reserve will cut rates. So right now, I think there's constantly numbers. It's almost like a betting market going on, if you will. So I think before the best guess was that they were going to cut rates in June. I believe now that's pushed out a month till July. So as we see better economic numbers come out and higher inflation or CPI numbers, that's going to push those numbers out because the Federal Reserve, if inflation is staying pesky, it's staying higher than expected, and if the economy continues to hum along, then they're not going to be in any hurry to lower rates. And a lot of this current move we've had is in some ways based off of that. As Brian mentioned, there's a lot of money on the sidelines, earning a nice 5% in the money market. As soon as the Federal Reserve lowers those rates, those 5% money markets are going to go down. It might take a little bit, but they will go down. So, when you're making zero or much less on those money market funds, a lot of people will then put that money back to work in the stock market. So we'll see a lot of that money, come back in. And that will be a huge boost for the economy when it happens.
Yes.
So,
Excellent.
go ahead, Brad.
Employers added 353,000, right, Chris?
Yep. Yeah. So the next read I have, employers added 353,000 jobs in January. That was the strongest jobs number, if you will, in a year, and double what the economists were originally expecting. The unemployment rate held steady at 3.7%. And on the back end of it, the December payroll gains were also revised upward to 333,000 from 216,000. So, kind of like I was mentioning before, the jobs market is still remaining relatively strong, and we're seeing a lot of mixed signals there. I think it's been pretty public. I mean, there are a lot of layoffs happening, and Citibank came out and had layoffs. The biggest news now, Paramount, who streams the Super Bowl and big shows, they just did a large layoff. Microsoft, I think, said they were laying off a large fraction of their Xbox gaming team. So we have a lot of these layoffs, yet we continue to see the jobs market hold up. So, we don't know if that's going to remain, but it's interesting that it does continue to hold. And then the wage expectations came out, or wages that read for January came out, and they beat expectations. They were up 4.5% in January from a year earlier. So that's good to see, very positive. I mean, obviously, if wages are increasing at 4.5%, inflation's sticking around that 3% mark, that is positive, or we're actually seeing growth. We had a point where, at the high point where inflation was clipping 9%, even if you got a 4.5% raise or wages were increasing at that, you were net losing money, essentially. Goods were increasing faster than your paycheck. So it's good to see that we are seeing wages outpace inflation. That's a very positive from the economic side. So anything do you want to add, Brian?
Yeah. So, and the market's down today because we saw that move in inflation, core inflation, that was higher than expectations. And, there is concern, of course, that, the jobs number had a large component of government jobs, and the last jobs number did as well. And so last fiscal year, the federal government ran over $2 trillion deficit. And, essentially we're spending a little bit of money, a fair amount of money over in Ukraine, but nonetheless, it's not really American wartime. We're not involved in a war. We're just supporting others. So it's unusual to have that kind of deficit in not in a wartime. And so if we continue at this pace, then obviously the economy is going to be pretty good because all that government spending is going to keep driving GDP numbers up. So a certain percentage of the GDP was also government spending, and the jobs numbers were also government jobs. But that's not sustainable long term. Can't keep growing at that level in government jobs, and government spending on a deficit level can't keep going like that. Now, the Congressional Budget Office came out and postulated that we're going to see over the next 20 years our debt go up another 20 trillion from here to somewhere in the 50s, mid 50s, $50 trillion. And that's unsustainable. There will come a point where we can't handle that anymore as a country, and it's growing faster than our GDP growth. And that's when auctions start to fail and we have a currency crisis and everything else like other countries in the world have had. And just by way of history, many folks on this broadcast might be aware, the American currency, the US dollar, has been the longest currency that has survived without any major disruption or devaluation. The Deutsche Mark in the Weimar Republic blew up. I mean, on and on. The Japanese yen blew up. Many currencies eventually blew up. Americans' currency has not blown up yet. And I say yet because we're getting close to that. And it would create big disruption in our economy. So the fact that government jobs are increasing and government spending is increasing, if we pull those numbers out, maybe the economy isn't growing that well. Maybe the layoffs that companies are saying that they have to do and will be doing, maybe that's legitimate. Maybe the economy isn't as strong as people think. So, but right now, by the numbers, it looks fine, right? It looks fine. We just worry about the component of those numbers. The other issue, Chris, is we have seen inflation, which got terrible in 2022, up to a rate of 9%, come back down in the threes. Now, of course, the inflation rate was much higher in the 1970s, but they changed the calculation. So if you used the same calculation system that they did in the 1970s, we would have been in the mid to high teens in inflation again. So essentially, it was the same kind of inflation that happened in the 1970s. So we're back down to the 3% level. But if you remember from history, those who are around, Richard Nixon had the WIN campaign to whip inflation down. That came out. He was still in office when the oil crisis began before he resigned. Gerald Ford came in, Jimmy Carter came in, and we had massive inflation for a number of years. Then inflation did come down in the late 70s, and they thought it was whipped, as Richard Nixon had said. But then again, inflation didn't go all the way down to a 2% level, a Fed acceptable level. It went right back up. So starting in 1979, 1980, 81, inflation went back up. And that really torpedoed the economy. The federal funds rate went to 16.9%. So there's some concern that while we think we've whipped inflation at this point, the Fed says they won't do a thing until inflation gets down to 2%, and they won't be lowering rates. The intention was to lower rates in March, and they're not going to do that now. And they realize that inflation really hasn't been completely whipped. And so the expectation is we're going to have 3 interest rate decreases this year, and that'll help the economy get moving. But if inflation comes back, they won't be able to really do that. Maybe they'll do 1 decrease in interest rates, but then they'll turn right around and raise rates again. So who knows where that could go, because interest rates would slow down the economy and slow down the spending by raising interest rates. And then that would hopefully whip inflation at that point. Inflation together with a stagnant economy is called stagflation. And that's probably what would happen, because they would need to kill inflation before they can get the economy going. Economy that survives on inflation is essentially going to unwind and unravel on its own. So that number one is to whip inflation. And so far, they really haven't done that. We're seeing the last 2 months, we're seeing 2 readings that are slightly moving back up. Let's hope that is just an anomaly and not a trend. But if it continues, we go back up in the 4s and the 5s and keep going back up, well, then we got to raise rates, and we're going to have a rough economy. So we'll see how it goes, Chris. But that's the fear. So when we look at these numbers, they look rosy, but we've got some government element in there, which is concerning. And we also see inflation slightly coming back up. So while the economy appears to be chugging along, there's some concern here. That's all we're saying.
Mm-hmm. Yeah, no, and I think it's a valid point. I mean, I think that I think the pro of it is it seems like the Federal Reserve so far, obviously they haven't raised rates, and I think they're trying to push off that speculation. So hopefully they stay, or lower rates, I shouldn't say. Hopefully they stay that course. I mean, I think, the longer we stay in this neutral mode to really gauge the waters, then they can kind of make that decision from there. But if they rush to lower rates right away, then we could get stuck in this reacceleration of the markets. Everything goes, swinging right back up. And so, I think it's something that the longer they take to make these decisions, hopefully we'll see a little bit clearer as far as, if it's an anomaly or if it's an actually acceleration in the underlying inflation.
And it's really anybody's guess which way it goes at this point. Certain moves by the government that they could make could cause things to go one direction or the other. And so we're going to have to watch it very, very closely. Chris, concerning the economy and the markets, we had another interesting fact about Japan hitting a new high, don't we?
Yep. Yeah. So just begin this week, the Japanese stock market, the Nikkei, climbed 2.89% to just under 38,000. And that's at the highest point it's ever been at since January of 1990. So it's, the Japanese market's really seeing a big boost of inflows, mostly due to some of their undervalued companies, and their currency's been very, very weak. And that's I would say, drastic difference to the U.S. market, which is a very strong U.S. dollar right now that is continuing to strengthen as recently with this recent CPI number. And a lot of our companies people would consider as overvalued, especially compared to international companies. So very different, but we're seeing the Japanese market hit not all-time highs, I shouldn't say, but kind of retrace back to all-time highs, which is good to see.
It is good to see. So let's talk about that in the context of what it means to investors. So now we're in review season here at 4-Star, where all the advisors are doing like an annual review for 23 in the first quarter with their clients and reviewing what happened, how their financial plan looks, what is the outlook for the future. And that's an important process to go through. And so we do that every year. And some folks will do a mid-year review also. And so we often talk about how markets will correct and they'll go down. We'll either have a 20 or 30% decline, or we'll have a full out 50, 60% decline in bear market, catastrophic bear market. And about half the time it happens that way, and half the time it happens just at 20, 30% level. So when we do reviews and we review to see where folks are in the financial plans, usually the bad years are when the market is down big. And the 2022, I call the worst investing year of my career. That would have been a year that if their financial plan was going to fail and the numbers were wrong, that would have been a year it failed. We're proud to say that we have enough cushion built in and a plan structured that none of our clients' plans failed. 2023 was an up year, although not as an up year as much as the indexes, because the average investor only did about 5 or 6% on a blended portfolio. But yet the indexes were up much more than that. And that's because the bond market was down. So it's a very confusing year. But that wouldn't have been a year, however, that financial plans would fail because the markets were slightly up. But nonetheless, the question always is, when would my financial plan fail? Well, if we had 3 or 4 years in a row of bad markets, well, that could fail. The obviously other reasons a financial plan might fail would be if you spent too much money or you didn't put all the investing money in that you thought you would. Those are different issues. But as far as the returns, if you don't get the returns, or negative returns for 3 or 4 years, that would affect it. So Japan is now coming to a new high after 30 years. And so what if we had a 30-year bear market? Because it went basically in half and it didn't go up for a long time. So people didn't get the returns that they wanted. And it was partly because the Japanese market and Japanese economy allowed substantial leverage on all their real estate, much, much more leverage than the American economy has ever allowed, 4 and 5 times leverage on the same equity. And so eventually that all had to unwind, and it took 30 years essentially to unwind it. And that's what's going on. So have we had that kind of situation in world history where we've had a long-term bear market? Yeah, it was in Japan. And so we hope that would never happen in America. Chris, let's pray to God. But is it possible? Anything is possible. It's improbable, but it is possible. And things that are on the horizon that could cause something like that, if we continue to add to our debt, we do add another 20 trillion in the next 10 years. That would be very, very serious, because we would not be able to handle our debt. It would be a currency crisis. Maybe the markets would crash, and we'd have a serious problem. And depending on how bad it got, maybe we wouldn't recover right away. And that would affect everyone's financial plan. So when we talk about how the government needs to either pay off more debt or grow into the current debt we have by not adding more, that's why we talk about that, because we want to make sure that the financial quality of our country and our financial lives individually is sound. But if we keep adding debt, then we're adding to a risk that it could be an existential risk for our society. So that's why we're very focused on not adding debt, growing the economy, and making sure that if we have a chance to pay off some of that federal debt, we should. And I know a number of the presidential candidates have talked about that, and we'll see what happens on that front. So anyway, we just wanted to cover that because that's relevant to investors. It's relevant to their lives and how they live their lives. And we're about financial planning to make sure that all the wealthy families that we work with continue to stay that way, continue to grow. So anyway, so Chris, and what we see out there, there's a lot of interesting things that we're going to just mention here before we close our show today.
Mm-hmm. Yeah. One interesting thing, Apple released last week its $3,500 Vision Pro headset, which, if anyone's seen it, it looks kind of like ski goggles on your head and looks like a person from the future, because people are apparently walking around or sitting in a Starbucks and ordering a Starbucks with these goggles on their head. But early adopters have kind of sold out the originals, the original line that came out. But it remains really to be seen. I think the big news, is this going to be a revolutionary product like the Apple iPhone that's going to take us to kind of that next step where I think everyone's seen, a futuristic movie where, computers are just kind of in the air, right? You're not having a computer screen, or you're sitting in an office or on a beach even to have a computer screen in front of you. That remains to be seen, or is this another offshoot gadget? And I would say, akin to what we've really seen right now with like the metaverse, which hasn't really come to fruition, I don't think, as far as what the expectations are. Is it just kind of a dream for this to reach? So it'll be interesting to see. Like I said, the early adopters have kind of rushed, on the ship there, but we'll see if it's generally adopted by everyone else. And then Eli Lilly is now being touted as the best candidate to join, as Brian said, the Magnificent Seven stocks, potentially kicking out Tesla. So Tesla has had a rough start to 2024 and really end to 2023. Eli Lilly, on the flip side, has just been surging forward based off of a demand for its new obesity drugs and diabetes drugs that are out there. So, I mean, it'll be interesting to see. I'm of the mind of don't ever count out Tesla or Elon Musk, but who knows? I know they just had their market caps actually just swapped. So Eli Lilly's market cap is now higher than Tesla's. So a lot of people are claiming that they should take over its spot. So we'll see if that happens, or if Eli Lilly's trend continues. And then the last thing I'll mention, Super Bowl happened 2 days ago. Congratulations to the Kansas City Chiefs, who won a thriller in overtime. But that Super Bowl drew 123.4 million viewers, which was a record TV rating. So it's the most people that have viewed a television show in history. It broke the record. So, good to see. Obviously, there was a lot of things going on with it. You had Taylor Swift, you had all that drama going on. So, but it's good to see that was the most watched, and it's really interesting. I think that you had such a wide demographic.
Well, and I say congratulations to Patrick Mahomes and the Kansas City Chiefs. So they're now they won two in a row, three in the last 4 years. They're becoming the latest dynasty after the retirement of Tom Brady, right? So and that's great for them. But then, Chris, I thought, if there's 123 million viewers, that's a lot. It's a record number. But there's 370 million people in America. So what are the other 250 million people doing? So
Okay, I guess someone's got
I
to
don't
work,
know.
right?
Yeah. So were they doing, they're doing ceramics? Were they reading? I don't, it's Sunday. It's not, maybe some people are still in church. I mean, I don't know. But maybe not that late in the day. But so I'd be interested to do a show on what do the non-Super Bowl watchers do? Because there's an opportunity there because 2/3 of the people are not watching the Super Bowl.
hmm Well, I think the Super Bowl is always interesting because some people just watch Super Bowl for the commercials, right? That's always been like so you have a lot of people that could care less about football. They just want to watch it for the commercials and the halftime show. So it's always been this broader than just the football junkies, if you will, or the people that are, love football. So yeah, I'd be very interested to see who's not even watching that. It's certainly a large event.
Yes. So anyway, if you were one of those people that did not watch the Super Bowl, let us know. We were curious what you were doing. And you can reach me at bkasal at fourstarwealth.com. Send me an email. What were you doing if you were not watching the Super Bowl? That would be interesting to know. And we'll see if there's any patterns or anything we can learn. Um, Chris, the other thing I wanted to mention, an interesting statistic came out about the changes in society in the last 40 years. In 1980, about 2% of all household assets were in IRAs and 401ks, which were new because 401ks only started in IRAs in 1976. Okay. So now that's fast forward to today, to 2000, beginning of 2024, and 38% of household assets are in there. So if you think of how radical a change that is, you go from 2% to 38% in a vehicle that didn't exist until 1976. So that was based on government policy and leadership of our country to change how people save and how people earn. What a great innovation that was. Create IRAs and 401ks. We get the tax deferral. So there's an incentive to put money in. Depending on your income, there's an incentive to get a tax deduction for making the contribution, or you get salary reduction. You don't pay taxes on money that goes into 401ks. So the government has given us incentive to do it. And it's really helped the net worth of America. It's helped the net worth of people all over the country. Back in 1980, very small percentage of Americans were investors. I mean, you say, 401k, IRA, yeah, you're an investor. You're either at mutual funds, you have stocks or some other real estate, other kinds of investments in your IRA, your 401k. So that is a good example of American changes that make America better. And so we're really glad to see that. And I just thought I'd point that out to everybody that that's a big change. Everybody naturally has a 401k, but they didn't even exist in the 70s. It was all a new thing. And so that's
hmm
really so congratulations to everybody who was smart enough to take advantage of that and have a big 401k. Chris, wouldn't you say?
Yeah, yeah. I mean, I think there was also, I think it was in either late '90s or early 2000s where they were doing some studies on the psychology of it as well, and they changed a few things as like auto enrolling employees into 401ks. So you had to kind of opt out of it to increase people enrolling in it, and then also having a percentage. They found helped increase because as salaries grew, if you were at a company, it would naturally, if it was taking a percent of your overall salary, so people wouldn't adjust or they wouldn't have to, just say $500. Well, if you increase your salary, when you get that take home pay, people just tend to increase their lifestyle. But if you don't see that, you don't feel it necessarily as much. So a lot of psychological aspects, I think that it's fascinating. I think really went into work to really drive that number too.
That's right. Well, good. That's good news. On a step on a positive note there. Um, I think that's all we have for today. I just want to highlight again, everybody, that on the 4starwealth.com site, we have our blogging sites. I have the leadership matrix that ties to the Today's Market Explained. There's an interesting post we did just the other day about the Federal Reserve. So the Federal Reserve is always changing interest rates based on things in the economy going on in the economy, and interest rates were low for a long time. So a lot of people are wondering if the Fed left rates too low for too long. Is the Fed mechanism that important anymore? Is the Fed really stabilizing the economy, or maybe they're causing the the disruption at the banks that's gone on in the last couple of years? Anyway, so we have an article out there that just talks a little bit about that. What would be the other ways that we could manage the economy if we didn't have a Federal Reserve? So it's a University of Chicago article. I thought I'd post that for everybody. And that's on the 4starwealth.com under the blogging sites further down the site, under the leadership matrix. There's a bunch of other very interesting sites there as well. The color stocks and a couple of others. So have a look at that. And then there's some other podcast interviews as well. There's all these podcasts are up on the site also. And then also there's the Financial Advisors Workshop, in which we interview the top financial advisors all across the country. Those are also all available on Apple, iTunes, Stitcher, Spotify. Not Spotify, I guess they're gone now. But all the other services. Anyway, but that's all available to you. And so again, please, if you like what we've done today, give us a 5 out of 5 ranking and share this episode with your friends. Chris, I think we leave it there for today, right?
Sounds good. Yeah, I think we covered everything we need to.
Okay. So on behalf of Chris Reardon and the whole corporate team here in Chicago, on the East Coast as well, and the 35 advisors that are now in 17 states that work with 4Star, we're proud of the development of the firm. We just crossed $1 billion in assets as a firm. And on behalf of all those great people who are out there serving the public, we'll leave it there. We'll sign off for today. We'll be back in a couple of weeks with a little more of an update near the end of February, and then some more interviews after that. Thanks, everybody. Good day.